Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your daily technical analysis of foreign exchange markets. I'll start with the euro against the dollar. A second bearish black crow on Friday and a follow-on to the previous session's reactionary bearish harami. The market was once again capped by the same overhead combined dynamic resistance that has done so imperfectly, I grant you, since May 2020. It is the combination of the upper time, currently at 113.80, of the broken January to May 2021 bearish Andrews pitchfork, as well as the declining medium moving average, currently 113.93. These two bearish resistances, though breached and broken, have once again successfully kept a lid on the market and pressured it lower, something that started way back last year. The low of the day was somewhat predictably amongst the combination of significant support levels below that are also pressing upwards. They are the short-medium moving average, currently at 113.29, the lower trend line of November 2021 to January 2022 ascending triangle, currently 113.26, and especially the neckline, currently at 113.13 of the April to May 2020 reverse head and shoulders pattern, plus just below that, the interesting 61.8% Fibonacci line of the March 2020 to January 2021 move at 112.89. All the action since the start of the year continues to be reminiscent of a potential pattern build-up, such as a diamond pattern, or maybe even a cat's ears pattern, or something similar. Unfortunately, this is still not that clear, but it will become so, and soon. So far today, a utilization of that combined support once more with a move up just over the upper time and halted by the nearby medium moving average. It is looking very much like a combined key reversal up and bullish engulfing pattern within the support and resistance levels, but it's still early. Increasingly, it looks like something is going to give way, and soon. Cable, aka sterling against the US dollar. A reactionary bearish harami on Friday as the market ventured a little too close to the overhead declining congestion of the July 2021 to date downtrend, currently at 136.64. Also the long moving average, currently 136.81, and the upper time, currently 137.09 of the October 2021 to January 22 bearish shift pitchfork. Overall, the market is getting squished in between these overhead resistances and the supports below of the 2019 high at 135.16, the flatlining medium moving average, currently 135.04, and a September 2020 high at 134.83. As you can see, I've retired the bearish Andrews pitchfork for the October 2021 to January 22 move. I had mentioned this previously, however, I will also retire for now at least the idea of the longer term whole of 2021 double top pattern, Adam and Eve type. Now the original initial target, X2 in the 133.60 area, was reached, but the secondary target X3 in the 131.10 area seems unlikely now. I've also drawn a new prospective early December 2021 to late January 2022 bullish Andrews pitchfork. This is a preliminary pattern and it recognizes that it has already been breached last week, but it may add some urgency to any moves higher as it starts running through the combined resistances overhead early next week. Either that or it will be retired. Now, so far today, I moved back up away from the new lower time, currently at 135.67 on the early December 2021 to late January 2022 bullish Andrews pitchfork, but not as far as the overhead combined resistances, not yet, at least. Euro sterling. A third bearish black crow on Friday and a suitable follow-on lower to the recent bearish dark cloud cover pattern. The market continues to test the previously highlighted support below, formed from the congestion between 83.60 down to 83.36, plus the broken but potentially still potent lower falling wedge trendline, currently 83.30 of the old August to December 2021 falling wedge pattern, as well as the middle time, currently 83.23 of the acute mid-December 2021 to early February 2022 bearish Andrews pitchfork. This is still an early pattern, so I'm quite happy to retire if it doesn't look like it is working, though this middle time does seem to have some merit. Finally, with just over a week to go, it is interesting to see if we are already set up for a possible monthly key reversal in February. If we close on the 28th either over 8400 or under 8350, then we'd be on. Right now we're looking at a possible monthly key reversal down. So far today, a reactionary move back up based on the middle time and recovering a significant portion of Friday's move, but it's not being held. US dollar against the Indian rupee. A strong bearish black mirror bozo on Friday that punched down and closed below not just the short medium moving average, currently at 74.86, and the medium moving average, currently at 74.82, but also, and perhaps more importantly, the new 2022 uptrend, currently at 74.96. Now, the reason why this is important is that it has triggered one, maybe two patterns. The first one I've pointed out beforehand. It is to regard the uptrend as the lower wedge trend line of the recent rising wedge pattern. As also mentioned recently, this move down counters the idea of the 2022 action so far as a possible bullish halfway hesitation. Thus, target X in the 75.90 area as a target for this possible bullish halfway hesitation is now retired. Instead, we now have a new potential target X1 in the 73.67 area. That is right on the 61.8% Fibonacci line of the July 2019 to April 2020 move. On the way down to this, we have support, quite a bit of it, from the 50% Fibonacci line for the April 2020 to February 2021 move at 74.63. The long moving average, currently 74.35. The 50% Fibonacci line of the February to April 2020 move at 74.26. And then the big 2018 to-date uptrend, currently at 74.03. And the August 2021 to-date uptrend, currently at 73.99. Before we reach the 50% Fibonacci of the whole of 2020 and the 2022 low at 73.74. That's a lot of support underneath the market. And it'll be interesting to see how the market deals with it. On Friday, the market penetrated the 50% Fibonacci line at 74.63, but did not close below it. Then there is the second possible pattern forming. Is the whole of the December 2021 action being a possible large bearish halfway hesitation? Now, this would give a potential target X2 down in the 73.15 area. For the moment, with the closer target X1 nearby, I will do more than keep an eye on that possible pattern and its target further down. So far today, a lower open below the 50% Fibonacci line at 74.63 and a move down that has penetrated the rising long moving average but being stopped short of testing the 50% Fibonacci line at 74.26. Currently, we've moved back up away from the long moving average. US dollar against the Brazilian real. An immediate countering bearish harami on Friday after the previous session's reactionary bullish engulfing pattern. Once again, the market was halted by the lows of early and late August plus early September at 5.13 even, 5.10.5 and 5.10.93, with the main stopping force being once again the interesting 38.2% Fibonacci line with the big October 2019 to May 2020 move at 5.10.87. Meanwhile, overhead, we still have the full Fibonacci-based band of congestion between 520.87 to 526.79. However, over all of this, what has been more important is that the market has still kept within the cone of the early January to date declining broadening wedge pattern, currently 522.90 down to 484.15. This wedge pattern, as detailed in its name, has been dictating the move lower since about mid-January, and still continues to do so, though I'm interested to see how well the supports will now hold up. US dollar against the Mexican peso. A second indecisive spinning top on Friday, thus with yet another consecutive close below the lower time, currently at 20.37.54, of the September 2021 to January 22 bullish shift pitchfork. Well, that pitchfork is now also retired, as had been the bullish Andrews pitchfork for the same move last week. Additionally, and more importantly, it was yet another consecutive close below the slowly rising long moving average, currently at 20.33.66. Whilst we may not currently have the aggressive nature one would look for with such closes below significant supports, one should not diminish the importance of what has been already achieved. You see, this is now a major breach lower, verging on a major break lower. If we can maintain these levels or lower levels, then we have the possible beginnings of a large bearish halfway hesitation. An initial target X for this would be in the 1985 even area. We would need a start and soon for this pattern to develop, hence I've drawn a preliminary mid-December 2021 to late January 2022 bearish Andrews pitchfork. It seems to have some merit, especially the upper time, currently at 20.45.85, which has been tested twice and held on as a resistance. It all depends now if the market will carry on with this pitchfork lower or not. Looking below, we now have support at 20.23.77, then the middle time currently at 20.0092, then 20.0066 and 19.92, even though the next sizable support will be the July to September 2021 based uptrend, currently at 19.97.80. Finally, there's a possibility to look at the late September 2021 today action as possible head and shoulders top or head and shoulders continuation pattern. I'll ponder on this idea a little bit more. So far today, nothing much. A dip down to last week's lows before a pull back up to a slightly higher open, but still capped by the slowly rising long moving average. Thank you for listening. This short version broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.